All right, that was the whole show in reverse. You saw it? We can break early, go get coffee. So I am Matthew Fienup, if we haven't met. I'm the Executive Director of the Center for Economic Research and Forecasting at California Lutheran University. It's a tremendous pleasure to be here with you today, to be in this beautiful venue in Thousand Oaks. So thank you so much for joining us. If you don't know the Center for Economic Research and Forecasting, if you haven't been to one of these presentations previously, I'm really excited to share just a little bit about the organization that I joined a little over 7 years ago. So CERF, as it's known, even long before I arrived, had developed a reputation as a very accurate, nationally recognized economic forecasting house. For all of the 13 years that CERF has been here at California Lutheran University, it's been forecasting a large number of economic variables at the national level, and has actually been the recipient of a very, very prestigious national forecasting award. We're members of the Wall Street Journal Economic Forecasting Survey. We're also members of the even larger National Association for Business Economics, NABE, economic surveys. Now, we believe that, goodness, this is going to totally give out on me now. Dan, you can go to the next slide. Something really exciting. So one of the things you need to know about CERF is that we are unconventional in our thinking. You have just heard what I hope you agree is a pretty unconventional view of monetary policy and its impacts in the United States. CERF is known for its unconventional forecasts. That's to say, in each of these surveys that we're a part of, including the Case-Shiller Home Price Survey, which is now called the Zillow Home Price Expectation Survey, we are often very, very far from consensus, right, from the average of all of those. And the reality is that since at least the financial crisis, it is actually paid to be unconventional. And so the last 2 years, 2020 and 2021, we were recipients of a Crystal Ball Award for the Zillow Home Price Expectation Survey, again, the Case-Shiller Survey, among more than 100 forecasting houses in the United States that participate in that survey. 2 years, in 2020, we were among the 5 most accurate, and in 2021, we were among the three most accurate. That's to say, we were ahead of the curve, calling the dramatic home price appreciation that we've seen in the last couple of years. I'm also really happy to report, this is news hot off the wire. Many of the Cal Lutheran people in the community don't know this, but as Dan and I were sitting in a parking lot at LAX yesterday waiting Danielle's arrival, we actually learned, let's see if the clicker will work, that we were actually just awarded our 3rd consecutive Crystal Ball Award. And so once again, CERF's U.S. home price forecast is really distinguished. And they actually give you a crystal ball. You need to come up and hold this thing. It weighs like 5 pounds. All right. And now CERF believes that the data, the forecasts, that all of that quantitative work is really only as good as the story you tell with that data. Right? And so in addition to doing cutting-edge forecasting work, we're also part of a number of other initiatives where really we're trying to use the expertise we have in economic forecasting, economic policy analysis to make a difference in the lives of our community, the state, and the nation. One of the really most exciting outgrowths of this is a project that Dan Hamilton and I have been involved in for the last 4 years. We partnered with researchers at UCLA on a very, very ambitious multi-year project to document the dramatic, the very large, and rapidly growing economic contribution of Latinos living in the United States. And the first outgrowth of that was the U.S. Latino GDP report. I really encourage you to visit the CERF website. The URL will be at the end to find out more about this really exciting research. What you see here is a presentation that we gave to the U.S. Congress's Joint Economic Committee. So this is work that is reaching a national audience and really making an impact in terms of changing the narrative about the importance of this critical source of strength, this demographic group that's such a source of strength and resilience. This year we're partnering with Bank of America and expanding that work. and doing both state and now metro area Latino GDP calculations. So this is really exciting work, and I hope that to be able to, at some point, have a presentation just on that work to this community. It's something we're really proud to be a part of. All right, so now let's jump into the forecast. So you've already heard some work, some pretty strong ideas about the U.S. economy. Before we dig into Ventura County's economy and the unique economic dynamics here that existed before the pandemic, the impacts of the pandemic itself, and the outlook, we do need to start big. Obviously, Ventura County is a part of the state of California, right? And that's to say that the performance of the California economy impacts what's happening here in Ventura County. And of course, there are macroeconomic impacts that are inescapable, right? Especially as you heard in this moment that we find ourselves in right now. All right, so in terms of making sense of the numbers, when we look back over this last 2 years, the economic variables themselves almost cease to have meaning, right? This is GDP data, real GDP growth, quarterly, and this is this bizarre measure that is the standard measure in the United States, quarterly annualized GDP data. How much did we grow over just since the last quarter, assuming that the current growth rate proceeds for four quarters total? And you get crazy numbers like minus 31%. Right? Does that mean the economy, 30% of all economic activity was retired? Well, not exactly. In fact, what's interesting about this particular data is that the pandemic, the impacts happened in March, the last month of one quarter, and April, the first month of the next quarter. If they had happened in April and May, you would see a number more like minus 80%, all right? So the numbers are sort of disconnected from the story. What does all of that mean? Well, one thing that's evident when we look at this is, well, wow, those are a lot bigger than those, right? And so when we think back to the Great Recession, right, we call it the Great Recession, right? We just experienced 2 years of economic displacement that frankly dwarf the Great Recession in a number of levels, right? And so the numbers themselves don't mean that much, but it's clear this is a huge impact. Now, I understand what Danielle was grabbing. Sometimes it wants to work, sometimes it doesn't. And so what we've done is actually, we think, first of all, this is an event, an economic event in the United States that actually operated not on a quarterly cycle anyway, right? This was a daily, weekly, or monthly event. And so looking at monthly GDP data actually starts to give you a unique picture, just how big the decline was. Right? This is an unprecedented decline in economic activity in just 2 months, right? And you know this, we lived through this. Shelter in place, orders, and the resulting displacement. Now, interestingly, if that will go back for me, there's two things. How big is the drop, and where are we relative to where we would have been? So one of the things that we're always asking is, well, at what point did we recover the pre-pandemic level of economic activity? We'll show you some tables, and the obvious question is, there was a drop, well, when did we get back to that February 2020 level of economic activity, right? When you see as you come across, well, we did that sort of in early 2021. The better question is, where are we relative to where we would have been had the pandemic not happened? And so what we're showing you here is the pre-COVID-19 forecast of economic activity. This is what we were predicting in, actually this is a January 2020 vintage forecast, and you see that red line. And interestingly, in GDP data, we actually have recovered the pre-COVID trend of economic growth. Now, it's not all a good story. There's a major disconnect with jobs, and we're also going to show you that if we could continue this bar, we're anticipating chronically slower growth in the medium to long term as a result of some of the pandemic interventions. And so that's to say, if this red line were to continue, that we anticipate a divergence in 2024 and after. Now, if we look at jobs data, it's a strikingly different story. That's to say, not only have we not at this stage even recovered the pre-recession level number of jobs, pre-pandemic number of jobs, we are nowhere near rejoining the pre-pandemic trend, right? And so there has been permanent displacement in the labor market. And so that's sort of the economic picture. I want to try and give you a sense of the scale and where we are and where we're headed. As Danielle has already hinted, the economic issue of the moment is inflation. And so this last month, we will actually get a new inflation data point in 2 more days. But the most recent figure that dropped was 7.5%, the highest inflation rate in over 40 years. Right now, the consensus forecast in the Wall Street Journal survey that we're a part of is for a 7.8% figure to drop in 2 days. And so this is for those of us who weren't adults or older in the 70s, this is unimaginable inflation, right? Through the 80s and 90s, we didn't experience anything like this. More importantly, I think the most important figure that captures what inflation means for the U.S. economy is to actually look at average weekly wages, right? So it is true that wages are rising, but unfortunately, wages will always lag price increases. The way that mechanism usually works is that as price increases, as the cost of living goes up, workers negotiate for higher wages, and unfortunately, because of that process, they will lag those, they will never catch up with those price increases. So wages have gone up, but nowhere near the amount necessary to recover the loss of standard of living that individuals have suffered during the last year. Average weekly earnings in real terms after accounting for inflation declined 3.1% across the United States over the last 12 months. Inflation obviously has the biggest impact on those in our communities who are the most at risk, and that's to say lower and middle income families in particular. Now, we take a very strong position on what the source of this inflation is. You've already gotten a preview with it. Danielle is of the same mind, but we believe that this is not simply the result of the unique ways in which the pandemic affected the supply chain and other aspects of the economy. There is no doubt that that through the channel of particular categories of prices like used and new vehicles, that there was an impact of the pandemic on prices. But we see this as unmistakable monetary and fiscal inflation. Right? So this is data now. This is not just PPP loans. This is all of the different categories of relief that were passed over nearly 2 years. And this is considering a family of 4 living here in the state of California. So first of all, if you're a family of 4 and you qualified for every single piece of relief, the maximum benefit was $110,000. And the average benefit, obviously not very many people meet all of those categories, but the average benefit was $65,000. That is about the same as the median income in the state of California, right? And so this is money that was pushed out into family balance sheets, and so of course that's a lot of money chasing goods. Now there's a very, very strong monetary component to this. What we saw over the last 2 years was that the Federal Reserve monetized all of that debt. There's a number of quotes that I think people may regret. She already mentioned Powell may regret ever using the word transitory. And my hope is that Neil Kashkari will regret using the word infinite, all right, at some point. So he actually said this in March 2020 to reassure the American people there is an infinite amount of money in the Federal Reserve. Well, so let's show you what an infinite amount looks like. This is what it looks like. It looks like $9 trillion in assets, treasuries, mortgage-backed securities purchased by the federal government. A remarkable number, $9 trillion. If we look in terms of the money supply, right? This is the amount of money in circulation, M2 in the United States, and you see that it increased 30%. Right? The money supply increased 30%, and because of a fiscal channel, through all these relief packages, it went directly into family balance sheets. And not surprisingly, the savings rate soared. So the pre-pandemic savings rate was between 7 and 8%, and it soared to almost 34% during 2020 when those, and that's to say it wasn't even serving the purpose, which was very critically to protect the livelihoods of families who had been displaced from work, right, who had been shut out of work through no fault of their own. But the amount of money that was spent dramatically exceeded all of the foregone income and activity, and the money supply increased dramatically, 30%. And so that's to say 7.5, so those are the students in the room who know the quantity theory of money, all right, 7.5% could go for a very long time. Right? And so that's to say that we believe and have been arguing for 2 years that this could be a very persistent and challenging problem for the government going forward. You don't have to take our word for it. You can believe economic actors, people betting on these processes. This is stunning to believe. This is the New York Federal Reserve survey. They survey inflation expectations. What do people expect the inflation rate to be? And currently, the median 1 year ahead inflation expectation 6.7. So people believe 1 year from now, inflation will be 6.7. And this one is arresting. The median 3 year ahead inflation expectation is 5%. And so economic actors believe that inflation is going to be persistent. And once that expectation sets in, it's very, very hard, even using monetary policy levers, to alter those expectations. All right, now, I need to go back one. There we go. This is something that the CERF has been talking about for a while. It's nice to find others, professionals, echoing the same thing. There was a time where we felt utterly alone in our criticism of this. So this is from February 2020, when we filled out the monthly Wall Street Journal survey. We're often asked to score, just with a simple letter grade, the Federal Reserve. What's amazing is, way back in those days, let's see, 63% plus 15%, so about close to 80% of economic forecasters gave the Fed an A or a B. Lonely Dan Hamilton and myself were literally the only forecasters in the entire survey, 70 forecasting houses, to give him an F. They actually quoted us. We asked, does an IRS audit usually follow a quote like this? But I'm happy to say neither of us has been audited, all right? So that was pre-pandemic. We actually, mid-pandemic, unfortunately, the consensus had moved even farther. Dan and I were even more alone. So 97% gave them an A or a B. There was one C and there was one F. And so that's to say, it has felt a little bit lonely. In terms of words, they didn't quote us this time, but I do want to point out words people may regret. Here's an economist in the survey who said, like a good engineer, Powell opened the floodgates. All right, opened the floodgates. And what's strange is you see things like this, and you say, how didn't everyone understand that inflation was just around the corner, right? That if we were opening the floodgates, that's what would happen. If there's an infinite amount of money, right? That is a persistent inflationary story, right? And one we've been telling. And so not only have Dan and I felt alone, I do also want to sort of share with you, get this off our chest too, we're not only alone, we're not serious, right? And so you might remember this. This is from the President's press office, July 20th, when he said, there's nobody suggesting that there's unchecked inflation. Well, at least there's no serious economist. All right. And Dan, I might need you to help me move slides. There you go. The unserious economist at CERF. All right. So I'm going to pick up the pace a little bit. Danielle already made this point. I asked her to make this point. These are truly extraordinary interventions undertaken. This is not something that was a modest adaptation of monetary policy. What they did in 2008, what they doubled down in 2020, these were unprecedented, poorly understood interventions, not recommended by economic theory, and are proving to be very, very, very difficult to unwind. You can listen to Powell's words himself. They were meant to be very temporary, 2 to 4 quarters was the original thought on QE. It's now, of course, been more than 12 years. And as Powell says, the world has moved on. So what does the world moving on look like? Well, it looks like this. So Danielle spoke a little bit about the events of October 2018. She was actually talking about corporate credit markets, right? Obviously, the way I lived this as a family was through the S&P, right, through stock pricing. So she mentioned 41 days without a single junk bond, without a single corporate bond issuance, unprecedented in the history of the United States. Well, what I saw was a 19.7% drop in the S&P 500. So you may recall that Chairman Powell said he was going to increase, that the Fed was going to increase interest rates 25 basis points. There would be another 25 basis points increase the next meeting, and that they were going to start to let the balance sheet roll off. They were not going to sell assets, but as they matured, they weren't going to reinvest and buy new ones, right? And the market panicked. So the announcement came on October 3rd. By the end of the year, the S&P had dropped 19.7%. And it was then that Powell panicked as families saw this apparent destruction of wealth, and he completely reversed course. By January 4th announced, we didn't mean it, we're not normalizing, interest rates are not increasing. And of course, the markets were off to the races, all right? And of course, they are much, much, much higher than 3,288 today, right? That has continued. And so that's also to say, by the way, that as stock prices go, notice that prices are disconnected from economic fundamentals. Changes, price swings, whether it's real estate, whether it's stock prices, they don't reflect the underlying value of an asset or the performance of a company. In fact, often they are traded based upon what interest rate policy moves are anticipated. All right, so prices are disconnected from fundamentals. They no longer contain much of the information that's needed, right, to make business decisions about risk, about liquidity, and other important inputs. All right, so the other economic issue of maybe not today, but tomorrow is the national debt. Danielle mentioned 133% of GDP. You can see that is much higher than World War II. More importantly, the relationship between debt and economic growth is pretty well understood. There's a very large economic literature in this area, and the consensus in cross-country studies is that 90% is the important threshold. Right? Once a country's debt exceeds 90% of total economic activity, it starts to crowd out private economic activity, and that results in permanently lower growth. And so there's a number of studies looking at that, and that leads to our long-term outlook, right? And that is to say, the extraordinary interventions of 2008, doubled down on in 2020, in particular the dramatic expansion in federal debt without a credible strategy to pay that down in the years ahead, is really pushing down on the economic growth outlook. So to give you some numbers, what that looks like, 3.5% is sort of the sweet spot. That's the post-World War II average growth rate for the U.S. economy for the entire period 1947 until the start of the financial crisis. 3.5%. We grew at 1.9% in the decade after the Great Recession, and that's broadly understood to be a period of anemic growth and increasing economic inequality. We did get sort of a bump in growth in 2018 and 2019, and our long-term forecast is for 1.4%, right? I think the nonpartisan Congressional Budget Office is around 1.5%. And so that is to say very, very slow growth. Now, why do we care about growth? We care about economic growth because there's other things we care about that are highly correlated. Economic growth has a tendency to produce upward mobility, greater economic opportunity, and greater economic inclusion, right? And so what that means is that the slow growth of the next decades, we expect to be accompanied, very unfortunately, by increased less mobility, greater inequality. And so that's to say this is a very significant challenge for the citizens of the United States and of course for policymakers. And it will take some very fundamental changes in federal fiscal policy to change that outlook.